Welcome to the Learning Corner. Don't forget to subscribe, share, and comment. Now let's dive into our topic for today. Ever wondered what distinguishes stocks with dividends from those without? Buckle up as we unravel this conundrum together. We start with the basics. What are stocks? Commonly known as shares, stocks signify ownership stakes in a corporation. By purchasing a stock, you're essentially acquiring a fraction of that organization, thus becoming a shareholder. The performance of the company directly influences your stock value. The company does, the more your stocks appreciate. However, if the company falters, your stocks diminish in value. Next up, dividends. These are portions of the company's profits distributed to shareholders, a kind of thank you gesture for investing in them. Not all firms provide dividends. Some opt to reinvest their profits into the business for future expansion. So, what sets apart dividend stocks from non-dividend ones? The key difference is in how shareholders make a profit. Owning dividend stocks, your earnings come in two forms: capital appreciation, stock value growth, and dividends paid out by the company. Conversely, with non-dividend stocks, your earnings rely solely on capital appreciation. You depend on the company's development to boost your stock value. To make it more relatable, consider owning a tree. If it's a dividend stock, think of it as a fruit-bearing tree. You gain both from its fruits, dividends, and its growth over time, capital appreciation. A non-dividend stock, conversely, is like a bare tree. You hope it grows robustly so you can sell it at a higher price later. Thus, fundamentally, the difference between dividend and non-dividend stocks lies in the regular income that shareholders receive. Now, what are the benefits of investing in dividend stocks? Let's dive right in. One of the most compelling advantages of investing in dividend stocks is the prospect of steady income. Dividend stocks, as their name suggests, pay out dividends. These are portions of a company's earnings that are distributed to shareholders. This payment can serve as a regular income stream, which can be especially appealing for those looking to supplement their income or those in retirement seeking a steady payout. Next, we have reinvestment opportunities. When a company pays you a dividend, you can choose to use that money any way you like. One popular option is to reinvest it back into the company by buying more shares. This is called a dividend reinvestment plan, or DRIP for short. Through this, you can gradually increase your holdings in the company, and over time, this can lead to substantial growth in your investment. It's a bit like a snowball effect, where your investments can grow larger and larger over time. Finally, dividend stocks can act as a buffer against market volatility. The stock market can be unpredictable and prices can fluctuate wildly from day to day. However, dividend stocks can provide a level of stability. This is because the income from dividends can help offset any potential losses from a drop in the stock's price. Moreover, companies that consistently pay dividends are often well-established and financially stable, which can make them less susceptible to market swings. So, in essence, dividend stocks offer a number of benefits. They can provide a reliable income, offer opportunities for reinvestment, and can serve as a cushion against the unpredictable nature of the stock market. They can be particularly attractive to investors looking for a more stable, income-focused investment strategy. Thus, dividend stocks can provide a steady stream of income and a buffer against market volatility. But as with any investment, dividend stocks also have their drawbacks. Let's start with the potential for growth. Companies that pay dividends are typically more mature and have less need for reinvestment, translating to slower expansion. This means that although you're receiving dividends, the stock price may not rise as quickly as it might for a non-dividend stock, where the company is plowing all its profits back into growth. Then, there's the tax consideration. Dividend income is taxed, often at a higher rate than long-term capital gains. So, if you're in a high tax bracket, those dividends could end up costing you. Furthermore, while dividends can provide a steady income stream, they're not guaranteed. If a company falls on hard times, dividends can be cut or even eliminated. This can lead to a decline in the stock's price, eroding your investment's value. So while the steady income is a plus, the growth potential of dividend stocks may be somewhat limited. On the other hand, what are the advantages of investing in non-dividend stocks? Now, let's dive into the world of non-dividend stocks and uncover the benefits they offer. First off, non-dividend stocks often come with a higher growth potential. You might be wondering, why is that? Well, when a company chooses not to distribute dividends, it typically means they are reinvesting those profits back into the business. This reinvestment can fuel expansion, fund research and development, pay down debt, or even facilitate strategic acquisitions. All of these actions can amplify a company's growth trajectory and in turn cause a significant appreciation in its stock price over time. Now, let's talk about another benefit: the power of compound growth. Non-dividend stocks, especially those of growth-oriented companies, can offer investors the chance to benefit from compound growth. This happens when the increase in the stock's price is reinvested, leading to potentially exponential growth over the long term. It's like a snowball rolling downhill, gathering more snow and growing larger as it goes. Moreover, non-dividend stocks can offer tax advantages. Unlike dividends, which are typically taxed in the year they are received, the capital gains from non-dividend stocks are not taxed until they are sold. This means investors can control when they pay taxes on their investment gains by choosing when to sell their stocks. Finally, investing in non-dividend stocks can offer a degree of flexibility that dividend stocks may lack. Since these companies are not committed to regular dividend payments, they can adapt more easily to changing market conditions. They have the freedom to reinvest profits where they see the best opportunities, which can lead to greater profitability and higher stock prices. In essence, non-dividend stocks can be an excellent choice for investors seeking higher growth potential and the flexibility to adapt to market changes. They also offer the benefits of compound growth, tax advantages, and the opportunity for significant stock price appreciation due to reinvestment of profits. Therefore, non-dividend stocks may offer greater growth potential, as these companies often reinvest their profits back into the business. However, non-dividend stocks come with their own set of drawbacks. These stocks are often subject to increased market volatility. This means that the price of these stocks can fluctuate wildly, sometimes within a single trading day. For those who prefer stability and predictability in their investments, non-dividend stocks may prove to be quite a roller coaster ride. Moreover, non-dividend stocks do not provide regular income. When you invest in dividend stocks, you receive a regular payout, usually on a quarterly basis. This can be a steady source of income, especially for retirees or those looking to supplement their income. However, with non-dividend stocks, the only way you earn is when you sell the stock at a higher price than what you bought it for. This requires a keen eye for market trends and a willingness to take on more risk. So while non-dividend stocks can offer high growth, they also come with increased risk and no regular income. In conclusion, both dividend and non-dividend stocks come with their unique sets of pros and cons. We've taken a deep dive into the world of stocks, unpacking the nuances of both dividend and non-dividend varieties. To recap, dividend stocks can be a great choice for those seeking a steady flow of income. They offer the peace of mind that comes with regular payouts, and the comfort of knowing that a company's profits are being shared directly with you, the investor. However, it's also crucial to remember that dividends are not guaranteed, and a company's financial health can impact the size and frequency of these payouts. Moreover, dividend stocks can sometimes offer slower growth potential, as companies may reinvest less in their own growth. On the other hand, non-dividend stocks hold a different kind of allure. They provide the thrill of the chase, with the promise of potentially higher returns. These stocks can be an enticing option for those who are comfortable with risk and who are looking for capital gains rather than income. But with the potential for higher reward comes higher risk. Non-dividend stocks can be volatile, and their value can fluctuate drastically, depending on market conditions. And without the regular income from dividends, you're banking on the hope that the stock's price will rise over time. So, which is the better option? Well, there's no one-size-fits-all answer to that question. Both types of stocks have their merits and their drawbacks. It's all about aligning your investment choices with your financial goals and risk tolerance. Some investors might lean towards the stability of dividend stocks, while others might be drawn to the potential growth offered by non-dividend stocks. And remember, a well-diversified portfolio often contains a mix of both. It's about striking a balance that suits your individual needs and circumstances. So whether you're charmed by the regular payouts of dividend stocks or captivated by the potential growth of non-dividend stocks, the world of investment is your oyster. Ultimately, the choice between dividend and non-dividend stocks will depend on your individual financial goals and risk tolerance. Happy investing!